I welcome you to this conference call organized to discuss the financial results for Q2 of fiscal 19. I have with me Rajiv Lal, Avtar Monga, Ajay Mahajan and Pawan Kaushal. Sunil Kakkar has joined us as a special invitee. Before we begin, I would like to state that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. The result documents have already been shared with all of you. These documents are also posted on our website. I now invite Rajiv to provide key highlights of our performance for Q2 of fiscal 19.
Thank you, Vipin, and good morning to all of you. And this is quite a significant investor call for a variety of reasons, both personal and professional. I will come to that during the course of the call. But let me basically start with the routine narrative about the quarter. But before I do that, just a word of reminder and context. For the last 2 quarters, and more actually, we have been signaling to the market our focus on and determination to accelerate the process of taking care of and cleaning up the balance sheet. And if you recall, I had indicated, I think in the April call, Vipin, is that right? Yeah, in the April call, to you that we were expecting as a final push in this drive towards cleanup to take roughly in the range of 600 to 700 crores in additional provisions. And we would do that in a systematic way, that we would do that by setting and seeking benchmarks for additional provisioning, that we would do this by trying our best to sell as many assets as we could to ARCs. Having exhausted all efforts we thought were reasonable to actually resolve and recover by ourselves, including taking all legal action that is available to us through our judicial system. So I can say with some satisfaction that this quarter we have actually delivered on all those indications and commitments that we have made to you. And we did that by taking less than expected provisions than we had expected. So we took an additional 539 crores of provisions this quarter against our advances and our investments. Investments as in loan-related investments, not treasury. 539 crores of additional provisions as against the signaling of between 6 to 700. And we also managed to sell close to 2,400 crores of assets to ARCs at the value we were carrying, pretty much the value we were carrying, right? So really that is the headline development for this quarter. As a result of these actions now, just to summarize, we now have only 2,896 crores worth of stressed assets on our books, against which we now carry provisions of 2,317 crores, which is a provisioning coverage ratio of 80%. And I am confident enough to signal to you that we are expecting that this provisioning cover over the next quarter or two will actually improve to 90% because of certain actions and resolutions that are in a very advanced stage. So we will end up with actually less than 2,800 crores of stressed assets on the book with close to 90% PCR over the next quarter. At this quarter, we stand at 2896 with 80% coverage. Again, to remind you, we started this journey with a legacy book of close to 12,000 crores in stressed assets 3 years ago in October 2015. Against that, we actually, some assets became performing, and those amounted to roughly 2,600 crores, which brought the book down to 9,400 crores. From the 9,400 crores, we have sold in several batches to ARCs, the most recent one being this quarter, 6,800 crores or thereabouts to ARCs. And that should add up, if my math is correct, to a residual of about 2,800 crores, against which we now have a provision coverage of 80%. So from 12,000 crores down to 2,800 or 900 crores with an 80% coverage. You should also know that the latest sale that we've done, this 2,395 this quarter to ARCs, has been done for cash. Full cash. So this is completely off our balance sheet. And I think really kudos to the team, Ajay, Pawan, and Manjul, others who have been involved in this from our side, for getting this done in a very focused manner. So I mean, I leave the lessons from this experience to perhaps another time, but it just shows you that in the infrastructure space, despite best efforts, and time does have value. The longer you let these things fester, the worse the situation becomes. Our experience has been, even with a very aggressive effort, taking full measures through the legal system, invoking guarantees, whatever had to be done. The process is so time-consuming and complex that the loss given default is actually very high. And we are really talking about, if you take our total book and you were to assess our cumulative provisions that we've taken over the last 4 years against the 9,500 or 9,000 odd crores of stressed assets we have in the book, we've ended up taking cumulative provisions of I think 6,500 crores against the 9,000 crores, which means 33 cents on the dollar, 33 paisa on the rupee is what is the current residual value of these assets. So that's just a bit of macro perspective on and learning from our experience of cleaning the book. Now let me come back to, and this, by the way, obviously explains the one-time quarterly loss that you see this in the P&L. But I'll come to the P&L last. Let me now come back to the more routine presentation and suggest to you, if you have the investor presentation, go to slide 3. And by the way, all the description that I just gave you on your stressed assets, on our stressed assets, are on page 13 of the investor presentation. So coming back to page 3, to the more routine stuff, what I want to suggest to you and show you is that even as we have been spending so much time and energy in cleaning up the book, there has been absolutely no loss in business momentum. And you can see that from slide 3. You look at the rate of our customer growth. We are now at 3.5 million customers. 34.6 lakh customers. And this customer base continues to grow at the rate of 120 to 130,000 customers a month. If you just look at Q2, we added more than 380,000 customers, of which 53,000 customers were urban and 330,000 customers were rural. Actually, this is something we are really very proud about. When we started the retail bank, and just to remind you, we launched the retail bank only 32 months ago. Okay. So in 32 months, to have built a franchise of over 34 lakh customers, of which more than 500,000, 500,000 customers are actually urban, right? So the urban customer base is the anchor for our growing CASA franchise. The remainder of the customers are primarily rural customers, of which a significant chunk are actually rural women. So our total 3.5 million customers, my guesstimate is that about 2.5 million customers are actually rural women, right? And 500,000 customers are your urban liability generating types. So to build this in 32 months, and it's a very unique combination of customers, I think is quite an extraordinary achievement. Again, on a personal note, thanks to the team, Avtar and Co. For seeing through this journey to this date. Second point, quarter on quarter, pretty much, we've been driving the CASA growth. Our CASA to deposit ratio as of this quarter end stands at 13.3%, up from 8.2% exactly a year ago. Our CASA and retail deposit franchise, retail TDs, now exceeds 13,000 crores, as you will see from the bottom right box of page 3. And this is an indication of our expanding retail franchise, which goes beyond just CASA. By the way, retail CASA itself is about 2,600 crores. Yes. And it's up from 2,100 crores, 2,080 crores last quarter. So just this quarter, we've added about 600 crores in retail CASA to our liabilities base. So if you turn to page 4, this is the bottom. I've talked about the customer base. I don't need to elaborate on that. But if you look at our network, we had promised 206 branches by the end of the quarter. We ended the quarter with 203, but since the quarter we've opened another 3 branches, so we are at the promised 206 branches. These branches are complemented, as you know, with our BC distribution network, which stands at over 450. Our number of ATMs continues to grow, and equally importantly, the customer access points that are powered by micro ATMs are now 20,000. So these 203 branches are across 91 cities across the country, but the bulk of them are in the top 35 cities. So the national geographical reach of the distribution network, its size and its depth has continued to grow over the last quarter. Let me now turn to the financials. I will skip over the slide on the balance sheet, so take you to slide number 7, which gives you a snapshot of what has been happening to our funded assets. And here again, as promised, diversification and the composition of the balance sheet continues to change. The headline story is basically this, that our overall funded assets have remained almost flat, almost exactly flat, but the share of retail and non-infrastructure corporate has continued to grow. So retail book now, out of total advances of 75,000 crores, stands at over 11,000 crores, up from 9,300 crores in the last quarter. So we added a couple of thousand crores almost this last quarter. Our non-infrastructure corporate funded exposure has grown quarter on quarter 5%. It now stands at 29,000. And our infrastructure funded exposure has continued to shrink. It is now down to under 22,000. It shrank 8% quarter on quarter, 25% year on year. Even as we change the composition of the balance sheet, we have continued to grow our non-funded assets, and we have, and this is despite all the hiccups that you saw in the trade finance market. We have pivoted to do derivatives and FX contracts, given a very muscular treasury that we have, and therefore our total non-funded exposure now stands up at over 266,000. It's a quarter-on-quarter growth of 13%. And when you look at the corresponding numbers in the P&L, you will find that recurring fee income continues to grow quite nicely. Turning to page 8, this is what's been happening to our retail assets. As I said a minute ago, we now stand at over 11,000 crores in retail assets. These are all originated by us. Again, to have built a retail book this size and as diversified as it is in 30-odd months is quite a remarkable achievement, I think, even if I say so myself. To again draw your attention to the diversified nature of this book, you will see that our rural book has grown quarter on quarter from 3,600 to 4,300. A lot of this is the JLG loans, but the micro enterprise loans are also growing nicely. We are now up to 275 crores, up 33% quarter on quarter. The micro housing loan book is still small, but growing nicely. Likewise, the two-wheeler loan book is now up to 50 crores. The urban asset book is now 6,800 crores. The bulk of this is a very important anchor, which is the secured lending product, which is the home loan. And that is important also for us to develop our liabilities franchise. This product is a must to attract savings account customers. And that home loan book has grown 16% quarter on quarter. The overall book, urban book, has grown 20% quarter on quarter. Drilling down in slide 9 a little deeper into the composition of the wholesale book, the most important thing here is if you look at the line that is nomenclated ELC, Emerging Large Corporates, as promised to you, that is continuing to grow. It now stands at 7,900 odd crores, up 10% quarter on quarter. We've also done well in building our MNC book, which is quite a profitable book for all the cross-sell opportunities that it provides. And that is now stands at 937 crores, up 32% quarter on quarter. Infrastructure, as I have mentioned to you earlier, has shrunk 8% quarter on quarter, 25% year on year. Again, this is a position and strategy you are aware of. Our PSL book continues to shrink, not because we are not meeting our PSL requirements, but because it is much more efficient and less costly to build PSL compliance through the purchase of certificates. And we PSLCs, we will continue to do that through the year in order that we maintain PSL compliance. So we are overall PSL compliant. It's only in the subcategory of agriculture that we fall short. For such a large balance sheet, to maintain PSL compliance in such a short period of time is again, I think, quite a significant achievement. Slide 10, our treasury book. Our treasury book for the last 2-3 years had been grown very substantially. It had grown very substantially because we were opportunistically trading in the markets in order to take advantage of interest rate calls. We've made very significant profits over the last 3 years on the treasury book. As the macro environment has changed and the direction of rates has begun to change, we have commensurately shrunk the size of the trading book, and therefore you'll see our total treasury book continues to shrink. It is now down to under 39,000 crores as of September 18, down from 40,273 last quarter. Even as the size of the treasury book and particularly the trading portfolio has shrunk, we have also acted to shorten the duration of our treasury exposure so that we have protecting ourselves from any MTM risk on treasury. Turning to page 11, a little more color on the composition of our borrowing franchise. I think you have already seen the numbers I've shared with you on CASA. CASA is now over 13% as a share of deposits. It stands at 6,426 crores as of September, of which 2,600 odd crores is retail. And the wholesale CASA has remained more or less steady. The future growth of the CASA book really will come as the expanded branch infrastructure takes hold, will come from the retail side. And I wanted to give you at least my prognostication on the prospects for retail CASA growth. I mean, if you look at our overall customer base that does savings accounts, it's about 514,000 customers have savings accounts. And we have 2,600 crores in retail CASA. So that comes to about 5,000 rupees per customer, right? Now, over the last 8-9 months, we have expanded the branch infrastructure very significantly, as you have seen. So my expectation is that this 500,000 customer base could actually, with not too much difficulty, double from the existing branch infrastructure that we have. Right, Avtar?
Yeah.
So the customer base doubles, and I'm expecting that the CASA per customer will also rise steadily. So, and if that doubles, it should actually more than double. It should be, closer to 15,000 crores or 15,000 rupees per customer rather than 5. From the existing investments that we have made, we should get to a CASA base of anywhere between 12 to 15,000 crores would be my guess. So these are the investments that have been made. You have seen traction on the developing CASA franchise quarter on quarter, and this is what I hope and I fully expect will continue. So that's on the CASA element of our liabilities base. The other very important aspect of the developing liabilities base is retail TDs, which have grown from 5,200 to 6,800. This has been a very conscious decision on our part. We have actually made the rates on our retail TDs quite attractive in the marketplace. They are very, very competitive in the marketplace. And this is to prepare and build headroom for liquidity related to the merger. We will now, we are moving towards a significantly larger one-time expansion in the balance sheet with the merger with CFL. We had built up the retail TD base to test how quickly we could build that up. We've actually run down our corporate CDs from 21,000 crores to 12,000 crores because we know that that's the filler. Having tested what else we can do to build the liquidity gap, we now are very confident, especially in this uncertain environment where NBFCs are going through some turmoil. Our CD paper, bank CD paper, we believe will become much more attractive, and we should have little difficulty in building up the necessary liquidity for the merger, impending merger. So that's on the borrowing. Let's turn to slide 12. So, our stated strategy with respect to the changing composition of the balance sheet, retailization of the composition of our loan book has been with one singular purpose, not only to diversify risk away from infrastructure, but also to drive up the average yield on our advances. So you can see from this table that we have actually done that. Quarter on quarter, it's not been the easiest thing to do, but our retail yields have gone up from 14.9 to 15%. And if you look at our wholesale banking yields, they have held flat. As a result, the composite yield of our advances has gone up from 9.1 to 9.4%. Unfortunately, given the turmoil in the bond market and general macro turmoil, our cost of funds has also gone up by 200 basis points, and we continue 20 basis points, sorry. That's a big difference by 20 basis points, right? And we continue to be hobbled and handicapped at the speed at which we can manage our cost of funds because of our legacy borrowings. There are still, if you go back to the previous slide, they are still 18 plus 10, they're about 28,000 crores that still sit at 8.8% cost. And unfortunately, that is not shrinking, as I said, until 2021. So, but despite all of that, we are building up the CASA franchise at some speed. We have been able to contain the rise in our cost of funds to 20 basis points such that our spreads have actually held steady. Okay, so in other words, this is a vindication of the very simple strategy that we put in place about the changing composition of the asset side and the liability side of our balance sheet. We just need to keep doing this and need to keep doing this even faster. And as I've said in my previous commentary, having strengthened the balance sheet very significantly, cleaned up the balance sheet, our goal now is to strengthen the drivers of profitability, and this again reinforces the importance of the merger with CFL, because that is precisely what that will do. Coming back to the point about stressed assets, there are two additional points that I didn't mention in my introductory remarks about stressed assets. Is that, and there are two data points really I want you to focus on. The first is, look at our gross NPLs and net NPLs. Our gross NPLs now are down to 1.6% and net NPLs are 0.6. One more number that you will find, I think, in the very last slide, which is the capital adequacy ratio, slide 15, is having cleaned up this book in the efficient, aggressive manner that we have, our capital adequacy is still at 19.2%. Okay? So it's a significantly stronger balance sheet than we have before. Okay, last point before I come to the P&L, and this is not a slide that you have. This is a slide on our expenses. So if you focus on slide 14, your slide on P&L, and you look at our operating expenses, that for the first half stood at 1,100 crores, 1,108, right? My commitment to you was that this for the year would be around 2,100 crores. And I think standalone, right? So this doesn't include IBL. IBL is another 100 odd crores, right?
Yeah, 1,100 includes IBL, but our commitment 2,100 is for standalone. Yeah.
Okay. So Sunil is being very cautious here, and I would say that we need to be more aggressive about cost cutting, and I'll explain to you now how we can go about doing that cost cutting. So this is a little more color I want to give you on our operating expenses, because we have not, contrary to perception, lost control over operating expenses, and I want to emphasize this point. So the breakdown of this 1,108 for the first half of 2019 is as follows. Of this 1,108 operating expenses, 606 crores is expenses on account of our entire retail operations, which are growing very rapidly. And when I say retail operations, I'm only talking about L1 and L2. I'm not talking about corporate overhead. So L1 allocated and L2 allocated expenses related to all of our retail operations out of the 1,108 is 606. This is for the first half of fiscal 19. This number in the first half of fiscal 18 was 349. So the increase in expense has come almost entirely due to the expansion of our retail operations. Now the residual cost, which in the first half of 19 out of the 1,108 is 501. 501 plus 606 is 1,108. 606, as I said, is L1, L2 for retail. 501, therefore, is some surrogate number for all the expenses related to our wholesale banking and all our corporate overhead, including unallocated technology, right? That number in the first half of 2019 was 501. In the first half of 2018, that number was 478. So that's a 5% increase. It's less than inflation. So please understand that we have not lost control over managing our expenses. There may be room to cut some of these expenses, and I'm saying to you that we had indicated to you 2,200. We will come under 2,200 crores for the entire bank for this year. Now, before that, the merger will happen, so it will be very difficult to figure all this out. But this is my commitment and my reiteration of our focus as management to make sure to communicate to you that we have not lost control over operating expenses. So now when you put all this together, you come to the overall P&L, and the profits after tax for this quarter, driven primarily because of the additional 540 odd crores of provisioning that we have taken this quarter, that profits after tax number is, what's the PAT here? 359. Loss. 359 loss, right? And if you look at now, go to the income line, our operating income in Q2 FY19 was 596. It is more or less the same as it was in Q1, and this sort of reflects what I've been indicating to you earlier. Our overall advances are pretty much constant. All that has happened is that the composition of our advances has changed, but our spreads have remained stagnant. And therefore, overall interest income has gone up. Net interest income has gone up only marginally, but it's gone up from 448 to 468. More importantly is our non-interest income line, which has actually gone up from 123 crores in Q1 to 133 crores in Q2. And in that, look at the recurring fees. Recurring fees have gone up from 120 to 128 crores. Trade and cash management up from 36 to 39. Wealth management, relatively stable. But the bulk of the increase in recurring fees is coming from loan-related fees and from trade and cash management fees. And this goes back to the importance of our non-funded franchise that we are building in parallel. Other fees, which include investment banking, syndication, and such like, they are up, but I'm not giving much credit to those because of the volatility inherent in it. So please focus on our ability and execution on developing our recurring fee-based franchise income. Likewise for treasury, it's been, we had to take some mark-to-market losses because of what happened to FIMDA valuations with respect to our longer-term, longer duration, some assets that we had on the book. And so we've had to take some losses and provisions basically on our treasury book, which, given the volatility in the markets, it's a volatile income line. Operating expenses I have talked about, provisions I have talked about, and hence the result of 359 crores in losses. So let me now conclude with, again, a summary. What have we done? We have cleaned up the book and we have strengthened the balance sheet. We have continued to change the focus of the corporate bank away from infrastructure. We have built the retail bank. We continue to build it aggressively, both to generate liabilities and CASA, especially retail CASA, but also to move and pivot to higher yielding retail advances. And we have restricted our spending to basically only those parts of the business that we are investing in, are expanding in, and that's retail. The rest of expenses have pretty much been under control. So I'm quite satisfied with the performance. I can say with some pride that this management team has delivered on the commitments that we had made to stakeholders. I would like to now spend just a minute on a very important matter which I haven't dealt with so far in the presentation, and that's the impending merger. To give you an update on where we are with the merger process, we got our shareholders' approval, and thanks to all of you that voted for the merger. We got, if I remember correctly, 99.98% yes votes in our EGM. So thank you all for your support. We really, really appreciate it. Even the government, and thanks to them, they voted for the deal. Capital First had their AGM as well. They also got a resounding positive vote. So both the sets of shareholders have now given their concurrence to the deal. We have all regulatory approvals in place. We are now going through the final leg of this very long and arduous process, which is an NCLT public hearing, which lasts for 40-45 days. So we expect by the end of November both our NCLTs, ours in Chennai and CFLs in Mumbai, to have completed that process hopefully by early December. And then we will need to go once again to the RBI to report to them that we have now completed the entire process, get their concurrence, and then finally go to the ROC. It is our expectation that this entire process will be done before the end of the calendar year, so that we will start the new calendar year as a merged entity. That's the first point with respect to the merger. Second point with respect to the merger, and this is also on top of everything else that we've been focused on, there is also a lot of work on the transition that has been happening. I would like to say that on the transition work, this is one merger I would like to be able to say when it's complete, where the preparation for the transition, for preparation for day zero, has been much more significant and thorough than in most other mergers. And the consultants that are working, helping us with this, are similarly, that's at least the feedback that they're giving Mr. Vaidyanathan and myself, that this is indeed the case. And it is a delicate process because it involves some uncertainty. And we have dealt with the uncertainty on the front foot. Communications have gone out to all staff in both organizations, down to fairly junior levels in the organization, explaining to them what the organization structure is going to be for the merged entity. And I should give you a sense for that. For levels down to N-2 in the merged entity, out of 45 odd positions that have been clarified and filled, about 33, more than 3/4, actually are with IDFC personnel, IDFC Bank personnel. That's the first point on people issues. Second point on people issues is that all the control functions will remain substantially with IDFC people. So the nuts and bolts on the finance side, all the risk related work, internal audit, compliance, all the things that are vital for us to be compliant on day zero are now our singular focus over the next 2-3 months, to make sure that as this date hurtles towards us, that on the first day the merged entity goes live, that we are regulatorily compliant with everything that we have to do. This requires actually a huge amount of statesmanship from people, some people who will be displaced, which is inevitable in a merger in this kind. And I have to thank from the bottom of my heart for everybody that has stood by my side to continue to apply to themselves to the best of their ability under very difficult circumstances and complex circumstances. And you can see the results of how this management team has applied itself to continue delivering even as we hand over to the new management. So I want to single out a few people and thank them. Avtar, who's here sitting next to me. There is Pavan, Ajay, Bipin, M.N. Shah, who's not in the room, Rajiv Oberoi, Santosh Parab on the legal team, N.S. Rajan, our head of HR, who's had a very difficult task, delicate task to deal with. There are many people. Sunil, who's sitting right opposite me. There are lots of people involved in this. So, just thank you to all of you. Two more points I had, and I can now disclose it because we had a board meeting yesterday. And I can now share with you the name of the merged bank, which still is subject to shareholder approval, but I expect and hope that the shareholders will approve because it's a very sensible name for the new bank. The new bank, the merged bank, will be called IDFC First Bank. So this will also be subject to RBI approval and the shareholder approval, both of which are pending. But our board, the IDFC Bank board, has approved this in principle, subject to all relevant regulatory approvals and shareholder approvals. I think that the name signifies an important evolution of IDFC Bank itself, absolutely consistent with our strategy of visualization, and it brings in the best of what Capital First also brings to the table to create what we hope will be an extremely powerful franchise and a differentiated universal bank that will focus particularly on a retail market in a manner that competitors will have difficulty matching. A final point is that this could well be the last investor call that I do as CEO. And I just wanted to say that it's been, heck of a ride. It's been a great privilege to serve all stakeholders. And I will remain engaged, as you know, at the level of the board. And if the merger does take place, as we hope it will over the next quarter, then we'll have more engagement to look forward to in the form of a merged franchise. So I know it's been a little long-winded, but as I said at the beginning of today's comments, for professional as well as personal reasons, this was an important call, so I've taken a little more time over it. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Udit Kumar from Udit Investments. Please go ahead.
Yeah, I'm Udit Kumar from Udit Investments. Yeah, Mr. Lal, first of all, good morning to you. And I would like to know that in the merged entity that you said would be completed by the end of this year. So, what do you think? How Mr. Vaidyanathan, the Vaidyanathan grade, will take charge?
Sorry, repeat that.
When the merge is completed by the end of this year, so when will Mr. Great Vaidyanathan take charge of the bank?
We will take charge the day the merger is completed.
So when we will get the shares of IDFC Bank, the shareholders of Capital First?
Post merger completion, there will be a board meeting for allotment of shares to the shareholder of Capital Fast.
So how much time it will take, approximate?
Post first board, when it approves the allotment of shares, it will take close to 3 to 4 weeks to complete the entire Companies Act formality.
So most probably by the end of January.
Somewhere around there.
Yeah, that will be safe.
Yeah. Thank you. That's it.
Thank you. I would like to remind all participants connected to the conference, if you wish to ask a question, you may press star then 1 on your touchtone telephone. We would take the next question from the line of Rahul Marathi from Akash Ganga Investment. Please go ahead.
Hello. Good morning, sir. Just wanted to get some color on the NBFC exposure that we could be having and to ILFS, if any.
Sorry, repeat that.
And our NBFC exposure, and particularly in NBFCs to ILFS.
So we have no exposure to ILFS, that I can tell you. Our total exposure to NBFCs is 10,000 crores. Of that, 3,800 crores is to housing finance companies, and then there's a whole. That's 56 borrowers in NBFC space. Total exposure of 10,152 crores. No exposure to ILFS.
I think just to add also, this 10,000 crore exposure, nearly 96% of exposure is in A plus category issuers. So it's a very, very strong rated portfolio.
Yeah.
Okay. Thank you, sir.
Thank you. We take the next question from the line of Aditya Shah from Vikram Advisory Services. Please go ahead.
Sir, I just wanted to know that were there any additions to the stressed assets during this quarter? And if yes, then why?
No, so you see, we took additional provisions against existing stressed assets. Basically, that's all we did.
So because from what I understand, in June 2018, your stressed asset total was 4,827 and the provision coverage was 77%. If you wanted to do a 90% coverage, which you had mentioned in the last call, the total coverage, the provisioning would be around 4,344 crores minus the 3,717 you already did. The remainder would be only 627 crores of provisioning to reach a 90% level. Out of that, we have already done 539 crores this quarter. So, the remainder provision coverage to reach a 90% level should only be 100 crores or 90 crores. But as per the September 18 results, we show only 80% PCR, and to reach 90% it will be around 280 crores additional. So, where is the gap of 180 crores?
No. So we are expecting to get to 90% coverage, not by increasing provisions, but by reducing the stress assets themselves.
Finding a resolution.
So there will be resolutions that are in advanced stage of execution.
So again, so there was no addition to any at this quarter?
No.
Fresh slippages, I would say. Yeah.
Correct.
Okay. And when do we see, sir, the funded book really because what happens is that when we are increasing the retail, but we are reducing our infrastructure book, so the funded book does not increase. Correct. So when do we see that funded book increase?
Well, so what we are, now our priority is to get the merger done, right? So the expansion in the balance sheet will come very dramatically through the combination of the CFL balance sheet into ours. So our retail portfolio will certainly be 25,000-30,000 crores larger.
Yes. So that is because of the merger, right? But after merger, when do we see further infrastructure loans decrease by sellout or by increase in retail assets?
You will continue to see the infrastructure book shrink, but you will see the rest of the book continue to grow. So since the rest of the book will be significantly larger than the infrastructure book, the net decline in the infrastructure book will be more than compensated by the expansion in the rest of the book. So you will see net growth in the funded assets, which will start from next quarter.
All right. Okay. Yeah, that answers it. Thank you so much, sir.
Thank you. Next question is from the line of Shatish Bansal from Albatross Capital. Please go ahead.
Good morning, gentlemen. I just want to sort of ask a question around the exposure towards the housing finance companies. Very recently, some of the prominent, building and construction companies are reporting losses, and with Amrapali and Supertech kind of joining the fray. Just want to understand from your perspective, what is your current exposure to them, and how do you see, this particular, exposure of yours panning out in the near to midterm future, please?
Well, so you would, Pawan, why don't you answer that?
So I can put some color on that. So like you mentioned earlier, we have roughly 3,700 crores of housing finance companies, and I also mentioned that roughly 96-97% of the portfolio is very strong rated assets. We are not seeing any concerns on our portfolio from what we hold in the HFC book. So I don't know whether that gives you the color. And you also don't do anything in construction finance. Yeah, we don't have any construction finance, building finance
exposure. But so that's the overall picture. But we are also acutely aware that the NBFC world is quite turbulent right now. And so, I mean, if there is, God forbid, some systemic problem in the housing finance market or in NBFCs more widely, we don't know exactly what the impact of that on our portfolio would be. We just have to hope that the best quality NBFCs will remain liquid and remain protected. And if that were the case, then our portfolio would be just fine.
Right, sir. Thank you. Thank you very much.
Next question, please.
Sure. Next question is from the line of Sneha Kantra from Shubham Ventures. Please go ahead.
Sir, just now you mentioned there could be some release of the provision which will lead to the provision coverage from 80 to 90% in the stress book. So there are chances there could be some release of the income also from the stress book, which you are expecting some resolution on that front?
Yes, I mean, when this asset is resolved, it will release provision and it will also become, an operating standard asset.
Right.
So
There'll be some write back will come through the P&L, no?
Yeah. And so these resolutions coming from which sector or which segment it is?
So we don't want to get into too much detail on that, but I mean, you can figure out, basically this must be something in infrastructure because all our bad assets are in infrastructure only.
So basically it's from the power sector or telecom or other stress?
No, it is not from the power sector, I can tell you that.
Okay. And my next question is, you mentioned on the OPEX front, but how do you see your fee income to be panning out?
So the income, I think we expect to remain the recurring fee income to remain quite steady, because one thing we are seeing is that the cash management business quarter on quarter continues to build quite nicely in parallel with the diversification of our wholesale book. The fee income from treasury and from other items will continue to be volatile. So that I can't predict, although over the next quarter or two, our treasury income should improve. Beyond that, as to the volatility, medium term of that income stream, it is what it is. And therefore, we are focused on investing in and building out and stabilizing and growing the recurring fee lines that we have.
And so third quarter, the provisioning would be just on the standard assets and normal provisioning?
That is correct.
Okay, got it. And the merger is expected by the January 1st week, right?
Correct.
Okay, got it. Thank you. And the last question is, any stress is being still left out or pending in our books, or everything is being done and clear on that front?
Everything is clear, at least related to the past. The future, you and God know.
Okay, got it. All the best for the merger.
Thank you.
Thank you. We will take the next question from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, morning Rajiv. Just kind of probably repeating another question. In the pillar 3, we do have a real estate exposure of about 1,900 odd crores with a bit of a construction of 625, not necessarily related to developers, but what I really intend to seek is beyond the home loan and loans against property which has been put out in the PPT. What are the loans in business, MSME, maybe working capital, which has a land, building, commercial or residential as a collateral?
No, so we have a LAP book. You have a sense of the LAP book. It's provided to you in the composition of our retail portfolio.
Yes.
It's about 1,000 crores. That's it.
So, other than that, there is no exposure either directly or through a collateral to any land or building? Is that the assessment?
No. Let me just clarify. So, we do have what we call lease rental discounting of commercial buildings, which are not real estate under construction assets. These are all rental assets. So that we have. But we do not have any under construction, real estate, property finance, builder exposures. That's what we were trying to clarify earlier.
Yeah. Okay.
He is on operating assets generating rental yield.
That's fine, I guess. Yeah. And any exposure in, MBS, the mortgage-backed securities, at this point?
No.
Okay, because I guess we used to have close to 2,000 crores, right, as of last year end, by March, I guess.
I don't think that's correct.
There was one odd trade that we did in the DCM books for one very large reputable builder in what's called CMBS, but that was sold out within 90 days. So there is no exposure to MBS. What you may be referring to is what Pawan has already answered, which may be related to some LRD discounting with the top builders, 2 or 3 top builders in the country. There is no other exposure to the best of our understanding in MBS or in construction finance or in any other form of builder financing.
Right. That's very clear. Thank you so much.
Thank you. We take the next question from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Yes, sir. My question on this provision during the first half, we have made almost 500 plus crores, 562 crores to be specific. My question is whether we have done with this 750 crores provision or provision requirement may increase further. What is our assessment now?
Sorry? No, future provision. So no, the number we have closed out for September takes into account all our expected provisions on the legacy loan.
So, I mean, before merger, we had a number of 750 crores. Against that, we have already done 562 crores.
We don't need to do any more is what I'm telling you. We've done better than we had expected.
Okay. The second question, sir, on operating expenses growth, which is around 34%, and we are continuously investing in both in branch and the employee base. So, this kind of growth rate will continue, or do we see some moderation over there?
This you will examine when the new management comes on board.
Okay. Okay, sir. Thank you.
Thank you. Next question is from the line of Sumit from Zaba Capital. Please go ahead.
Yes, hi, gentlemen. A couple of questions. First, if I look at the operating profit for the quarter, it's a loss, and I'm talking before loan loss provisioning. So could you talk about what's the path to actually turn it around and make profit at pre-provisioning operating profit line? And second, if you could help me reconcile the movement in net worth quarter on quarter. Has there any item been taken directly from the balance sheet as well, considering the change in net worth versus how much loss you made in the quarter?
So I'll ask Bipin to answer the net worth question first, then I'll deal with the other one.
So net worth has gone down from 15,400 to 14,800, largely on account of the dividend payout that we did in July to the shareholders, and partially due to the loss in the current quarter.
That's it.
So there's nothing has been taken from the balance sheet, right?
And on the other thing, it's a continuation of the strategy. So the moment we are able to grow the funded balance sheet with yields that are superior, profits will begin to grow. And this will start happening next quarter, no?
The branch maturity will begin.
And as the branches mature, the CASA franchise or the CASA generation from those branches increases, and incrementally that has mitigating impact on our cost of funds. On the asset side, the yields will begin, the composite yields will start rising, and therefore overall spreads will improve, and that gives positive momentum to profits.
Right. Okay. And like your branches, you've increased from 150 to 200 over the last year. Where are you expecting to take your branch network to, and how much cost does that entail further, considering the kind of growth we've seen in costs for the 50 branch network expansion?
This is something that will be discussed by the new management as they share with the markets their strategy.
Right. Okay, got it. Thank you. Good luck.
Thank you. We would take the next question from the line of Rahul Saraf, individual investor. Please go ahead.
Yeah, so can I request you to have some words on the share price, which is actually continuously falling from last many days or months?
I don't have any words to share on the share price. I mean, this is for the markets to decide. I don't want to get into a discussion on market dynamics. I can only share with you, and this management can only share with you, what is within our control, which is operations and the P&L and the balance sheet and business generally.
Okay, thank you.
Thank you. Next question is from the line of Aditya Shah from Vikram Advisory Services. Please go ahead.
So just as a follow-up, am I correct in understanding that in the next 1 or 2 quarters we would be taking a provision of 280 crores to make it 90%?
No. Explain that again. So we are not making additional provisions to get to 90%. What will happen is that, actually this is an important point to clarify. We get to 90% by reducing the stress book itself.
By dissolving one asset which is in advanced stage. 28 to 24.
Weight will come down.
Yes, you get it? You understand that?
Mm-hmm. Yes.
But the stress assets come down. The denominator comes down.
Okay. Okay. And sir, on a standalone basis, without Capital First, do we have any internal targets of what the year-end profitability for the full year should look like?
It should look much better. From a loss to a profit, yeah. I mean, we don't normally give forward guidance on these kinds of things, but you should be able to tell from the quarter-on-quarter growth. So if you remove the one-off, you'll be able to get some sense of that.
Thank you. Well, ladies and gentlemen, this seems to be the last question for today. I would now like to hand the conference over to the management for their closing comments.
Just thanks again. As I said, it's been a challenging few quarters, but just to reiterate, it is with some satisfaction that we have come to where we are in terms of cleaning up the book and creating the foundations for the retail bank and diversification and such like. I am hopeful that the merger will get done this quarter before the end of the financial year, and look forward to your continued engagement, and thanks once again to all the team that have helped us get us to this point. Thank you.